I think real estate started the journey of our firm because we wanted to invest in real estate, and then real estate can save so much taxes. I was already a CPA, and I thought, why can I focus on this? And that's how both the things started at the same time. Real estate is, I think, the only one vehicle that gives you a long-term wealth with a very stable returns, and you don't have to be super smart. Even if you make mistakes, you can make money in real estate. In stocks, in bonds, and on crypto, you got to do your research. You don't know what's going on. You got to follow the market. Real estate is very forgiving in the long run. You can lose 5,000 on repair. You can lose 10,000 on repair for the first few years, but you look over 10 years, 5 years, 6 years, you can really make money and long-term wealth. And the actual investment strategy even had changed going forward. Before it wasn't, there was no Airbnb and short term, right? People were looking for long term wealth. Now there are people who actually make, even while investing in real estate, which also provides a lot of benefit of real estate itself, people have also started getting a short term, like huge cash flow features. I mean, a short term rental, mid term rental. So again, if you like real estate, you do have to like real estate, and you start making more money. But what people start doing is they will start investing in real estate. And I thought I would do the same thing. And I hope I can do more. And that's the plan for my long-term investment strategy as well. I want to get into more commercial properties and short-term rental, any kind of real estate that makes sense in office buildings. I'm actually getting back into real estate starting this year, and everyone can benefit from that because I know on-hand experience of that. And second thing is this: since we can talk about taxes, bonus depreciation, they have been talking about bringing back the bonus depreciation. Bonus depreciation really helps us save taxes while investing in real estate. We're focusing on tax planning and tax saving strategies. And so that's how, again, real estate saves taxes. And if you're smart, if you want a stable return, and if you want to diversify your portfolio, it's a very good asset to have in your portfolio. I see we have a lot of people in here from everywhere. Thank you for joining, guys. Remember, we do this often, and we do repeat same things sometimes. Hopefully this helps you guys learn more and more about tax savings and big things you need to do. I'm not going to focus on small things because remember, if you file a newsletter or if you have ever contacted us in the past, you would have received a very detailed and more improved newsletters from us, which describes the small strategies, and our social media has done a great job of putting out information there. I'm going to really focus on a few things you need to understand before you're filing your tax return, if you're going to file a tax return in the next few weeks. And remember, your tax return can be filed at the middle of October. So this applies for that as well, depending on if you have extended or not. So depending on what I'm going to say today, if you plan to extend, then this applies to you for next 6 months. If you don't plan to extend, then it applies to you over next few weeks. Both of those will apply. So please keep that in mind. So we're going to go through a few stuff, and I'm going to walk you through a few things today as well. And while we're doing so, please ask questions and I'll start reading them and answering them.
What do you think is better, a long-term or short-term investment?
So remember, as a CPA, if this was like an engagement and I was talking to my client, I would not advise them on investment strategy. This is because legally, as CPAs, we cannot do that because we are not investment strategists for you. However, from tax standpoint, I can touch into tax standpoint and how portfolio optimization works from tax standpoint between short term and long term. But as an investor, though, I do want to tell you how I would think. Long term rentals are great. It gives a lot of income, and it also depends on the cycle. There are people who have made a huge amount of money from short term rentals in the last 2 years because of the way the market was. When the economy goes down, people start vacationing, and then people will see the struggles now with the short term rentals, and they will start laying off the short term rentals. It goes back into the market, cycle reverses, and people buy the same property and it reverses. So you need to really monitor the market if you want to have a good investment strategies. Depending on where you live, self-management, and then your family commitment, your investment commitment, short-term rentals can give you a very strong cash flow, unlike long-term rentals. Long-term rentals from investment standpoint gives you a very small single-family house, let's say. If you buy long-term rentals, your monthly cash flow is $200, $300, okay, if you have a decent property. That's not much money. It's like 3,000, 2,000 over the entire year. That's the
Right.
cash flow we're talking about. Short-term rentals can make 50, 60, 100 grand in a year. Can you have both? Yeah, you can have both. Have a long-term strategy, safe asset, and have a short-term rental. Make this use cash flow when the market is right, and then maybe convert them to long-term rental when market is not right. One aspect of cash flow investment strategy perspective. The second is the taxes, right? That's what we do. People get into real estate for taxes. What you should focus on in taxes is how to optimize your portfolio from tax standpoint between short-term rental and long-term rental. Let me explain how this works. Everyone knows how short-term and long-term rental works, right? If not, maybe I should share this so everyone understand this. I'm going to share this one screen. This is our tax planning module, which is being converted to software right now. Not important if you guys are not interested in that vision of ours, but I want to show you how short-term rental and long-term rental works. Both of them are rental, but the structure works this way. Short-term rental is like a business. It's strictly from tax perspective. It's not a rental. Short-term rental definition is less than 7 days on average. Long-term rental is a rental. It's a rental property from IRS standpoints. How does it affect your tax savings? Both of them can offset your W-2 income or business income or any other income you have. If you manage your tax planning correctly, both of them can do that. However, you don't need real estate professional status. Long-term rental, you need real estate professional status. So the goal is to create losses to save your taxes, create losses, phantom losses to save taxes. How to do that? With short-term rental, you have to meet rental and material participation rules. For long-term rental, you have to meet that real professional status rule. So that's the difference between short-term rental and long-term rental. Now, which one is better investment standpoint? We touched upon that. Which is better from tax saving standpoint is what we're going to talk about next. Okay. First point is which one is easier to meet and which one you should focus on really depends on your lifestyle, honestly, your investment portfolio, and what's happening in your family. Rentals, everyone is doing this, especially if bonus depreciation comes back this year. Everyone's going to do this again. Short-term rentals saves you insane amount of taxes without a huge commitment like real estate professional status for long term. Short-term rentals, you have to meet material participation requirements, which are easy to meet. Long-term rentals has a strict reps status requirement, which is audited a lot, and it's difficult to meet, especially if you have other commitment as a full-time job or if you have businesses, right? So short-term rental and long-term rental needs to be optimized, and I'll explain that in the next section. What we just discussed, to recap, is which one is better depends on your life situation. If you have a W-2 jobs, if you cannot meet rep status, you're gonna lean towards short-term rental. If you have a housewife, or if you have a house husband, if you have a full-time job or business, then you can look into long-term rental and then get the same benefit from long-term rental. So first goal is to choose one to save huge amount of taxes, long-term rental or short-term rental to save taxes. Now, after that, it's time to optimize them together. And that's what we're going to talk about next. Let me see. We have a question here. It says short-term rental and long-term rentals. How does long-term rentals works from a tax saving standpoint, and what is long-term rental versus short-term rental? Long-term rentals is a normal rental lease you have with your apartment or your businesses, Costco with their warehouses. That's long-term rental. Short-term rental is anything less than 7 days is short-term rental. So if you buy Airbnb and your average stay of the tenant is less than 7 days, is a short-term rental. Long-term rental is the leases we just talked about. And we talk about how do IRS looks at them and what do you need to do to meet the requirements to save taxes. So first step is to either buy one of these, depending on your which strategy can you meet to save taxes, and then next is to optimize them. What do I mean by optimization? Let me talk about this. Okay, this is where things get complicated, and it's okay. You can rewatch this if you don't understand and ask us questions. Optimizing a portfolio. Sometimes, if you do not have rep status, meaning if both of you have a full-time job and you cannot meet rep status, what people say, I'm not going to buy long-term rentals, it does not pay taxes. True statement, but in the long run, you need to learn to optimize short-term rental and long-term rental. This is how you're going to optimize. bottom line is, first you're gonna buy short-term rental. So this is what you're gonna do. First, you're gonna buy short-term rental. Short-term rental saves you a lot of taxes. And I'm gonna walk you through the numbers next. And then that tax savings happens the first year with cost segregation. Next year, as we discussed before, short-term rental inherently makes more money than long-term rentals. When you make $100,000, $50,000 from short-term rentals, what happens there is short-term rentals giving you extra income. It's making you 50, 100 grand extra. Gets taxed at your highest tax bracket. Now you can buy long-term rentals, which could have never saved you taxes at the other income level, like a W-2 income could have never been saved with long-term rental or any other business income. However, though, once you have a short-term rental, you can buy long-term rental, do the same strategy, cost segregation, harness these losses with bonus depreciation, and you can use long-term rental to offset the short-term rental income. Before you could never do that. So when I say portfolio optimization, what we mean is this. Long-term rentals by itself could not save you taxes without reps. However, if you could never be a reps and you buy a short-term rental strategy and you go into loophole, you save taxes, you can always now go back and invest in long-term rentals to save taxes at the short-term rental level. Even if you are never going to be a rep status, now a long-term rental could save you taxes every year without delaying the tax savings because you have a short-term rental. That's how you're going to optimize your short-term rentals versus long-term rentals. Is this complicated? Yes, it is complicated. That's why you got to work with your CPA to understand this and numbers and how this works for your portfolio. But I guess what you need to take away is what you should focus on is, okay, I understand I cannot be reps. Immediate tax benefit comes from short-term rental. I'm going to invest in short-term rental right now. But don't get into that mentality that you keep on listening everywhere. You could now save taxes with long-term rentals if you were to optimize your portfolio. So that's the short-term rental and long-term rental and how they interplay. Does this make sense to you?
Yeah. And I think that you've said it before in previous webinars that you have to be passionate about it and willing to put in the work to really see the benefits of it.
Yeah. See, real estate is not about just tax savings. A lot of rich people get into real estate because they have a lot of tax savings. But when you start as an initial investor, you will not have a property management just to dump your day-to-day management. You're going to deal with this tenants and stuff. You need to have at least some kind of longing for real estate to at least be successful in this. And later on, as you grow your portfolio, you can always outsource your management and act more like an owner versus a landlord. But when you start, though, that's what you're going to focus on. Just to wrap up this concept of being a landlord and people, rich people to do this, it's how it works, guys. And you got to think in steps. When you get started in real estate, you think like a landlord. You want to get this rep status. You want to save bonus depreciation. You want to make all this strategy we just talked about. You got to focus on that. However, when you expand as you get older, let's say, and you get wealthier because of real estate, then you got to think like what rich people do. Rep status and short-term rental not very necessary. All you need to do is buy real estate, have other businesses where you're passive as you're wealthy, and use them to offset each other. What I mean is, let's say, a doctor or an initial business owner, they get into real estate because they make $1 million as a doctor. They want to buy a rental, make it both non-passive and offset each other. What rich people do is they make this $1 million, but they make it passively without going to work every single day as a business owner. They hire people to do make money. And then they buy real estate without rep status, just buy whatever property they want to buy, make it both passive and offset. Wealthier people who value their time more and want to save taxes, make it both passive. That's simple. But again, you do need to understand the concept with your tax advisor if you want to understand this even better. And we'll leave that up to you and your tax advisor to explain that if you want to work with us in a little more detail in your numbers. Okay, that's where we're going to stop this topic. And I'm going to walk you through some numbers, everything I just said. And remember, the whole purpose of this call was to what you should do before filing your taxes. And we're going to touch on that also after I run through this one quick number. So everyone makes sense when I say about real estate and how we save taxes. Don't get hung up on too many numbers here. All you need to understand is, let's say we have this taxpayer. We don't even need a name, lives in Colorado, is married, and let's say makes $700,000 a year. Pretty simple, right? Not complicated. Makes $700,000 a year. How does real estate impact him or her? is what I'm going to show you, and then we can talk about what you should be doing before filing taxes this year. We have 300 strategies on our tax planning. I'm going to focus on tax savings with real estate. I know it looks a lot here, guys, but what this is, basically we have all the tax savings, how it works, and then we walk you through that. We give you deadlines and complexity, but I'm going to walk you through this. So this is how it works. Let's say bonus depreciation comes back to 100%. How does this real estate save you taxes is what I'm going to talk to you about next. This guy who made $700,000, if you were to buy a $2 million property, you could completely wipe out $189,000 of taxes you pay into the government. That's the bottom line. This is how people invest in real estate. You make $700,000, your majority of your taxes is gone. Let's say this guy makes $600,000, even $500,000, but $600,000. How does this work for him? If this guy does nothing, he's going to pay $166,000 on taxes. However, let's say this guy talks to the CPA, understands real estate, wants to expand his real estate strategy. Then this guy can save. Okay, let's say go understand his threshold. Okay, what is my maximum I need to buy to save taxes? And he goes and buys long-term, short, depending on your strategy. So this is how it works. Do you see this? That this person has a zero taxable income because of real estate, because he can reduce his taxable income by that amount because of his investment of $2.5 million. That's his maximum threshold. So you need to understand the threshold with your CPAs. But let's say you don't invest in maximum amount. You only spend $800,000 in, let's say, Colorado. This person goes to Aspen and find this $800,000 property, which is unlikely. But let's say he does that in Asheville, or Florida. Again, find your short-term rental market. Or if you buy a long-term rental, same thing. To buy two $400,000 property, even $800,000 property saves you $66,000 in taxes if 100% bonus depreciation comes back. If it does not come back in 2025, that $800,000 saves you $27,000. If it comes back, it saves you how much? $66,000. So again, if it comes back, better. If it doesn't come back, still saves you $27,000, which you could have never received back anyway, right? That's how real estate works. Saves you taxes. And that's what we need to understand. Now, with this thought, what I'm saying is what should you be doing next before you file a tax return is what I'm talking about. Because people get confused. And I want to make sure everyone understands this. Tax planning is proactive. Everything I'm talking about is going to help you with tax return filing for 2025, which happens in 2026. Because right now you're filing tax return for 2024, but you're filing tax for 2024. So what can you do right now to save taxes in 2024 is extremely limited. But I want to make sure you guys don't miss out on 2025 tax savings, which is going to happen in 2026, right? So everything I said, you implement that in 2025, you have time. But let's go back and talk about what you should be doing before you file a tax return. Few things. Basic stuff what everyone should be doing is if you have IRAs and SEP accounts, you can fund them right now. Or even 401ks, employer contributions, okay, if you have a business, you can fund them onto your tax return. That's the only thing you could do. You cannot go back and hire kids now. You cannot go back and buy a vehicle. You cannot go back and implement Augusta. You cannot do any of that. What you can do is do those few things I just said. Now, the most impactful thing that you need to take away from what you could possibly do last year is with real estate. Obviously, you cannot go buy a new property for last year and do cost segregation. What you could do is property you have already bought last year, which you did not know about tax savings from real estate, cost segregations, or even if you have old properties that you have never done cost segregations, you have until you file your tax return to do cost and you report it. Everything I just showed you on my screen, that $27,000 tax saving, $66,000 tax savings. If you have a new property last year, if you did not know about this strategy, you can still implement that. You already bought the property. You just need to run the report and do the tax return. That's what you're going to focus on for 2024 tax return. And that's what this webinar was about. I don't want any taxpayers to file a tax return without understanding this. You need to file your taxes. If you especially invest in real estate, understand you can still go back and do cost segregation on your properties you already bought last year, or even old properties, you can still do them until October of this year. or September if you are extending your tax return. If you're not extending it, you have a month left for your individual tax return to be filed. This is what I meant. The most important thing you can do. Smaller things, IRAs, SSs, retirement accounts, but the bigger thing is cost segregations on your existing properties you already have, which you've never done that. So when would you do cost segregation in old properties or your new properties last year? Very simple. Same thing we discussed earlier. If you made a short-term rental loophole in a requirement that 7 days or less on your short-term rental, please do the cost segregation. If you have made the material participation requirement, basically you manage the property, or if you have made one of the 7 tests. I'm not going to go over that on this call. Long-term rental, please do the cost segregation under these 2 scenarios. First is you have other passive income or passive short-term rentals, or you qualify as reps this year, which you did not in previous years, and do the cost segregation on all properties. I know this is complicated, so you got to work with your CPAs to understand this in a little more detail. I'm just sharing this so you can initiate a conversation with your CPAs. What you need to take away from what I just said was this. Please go back and talk to your CPA and say, is this the right time for me to do cost segregation because I've never done so on my old rental properties? Just ask that question. If they cannot answer that, please find out on the CPA. If they can answer this clearly, then you're in good hands. That's all. Just to recap what we discussed is tax planning. Everything I just showed you is going to be for 2025. Please make sure you understand that. Do that going forward. For last year, though, everything I just said also applies. Initiate the conversation with the CPA if you have not already on all those things. That's what I'm saying. Now, I'm going to answer some questions we have. And then if you want to know more detail about this, please, we have shared all those emails earlier. We'll put that in chat again, all our emails can see. And then please reach out to us. I'm more than happy to answer those questions through emails. If you want to schedule a free consultation with us, again, so we'll give you a link. Please do so you can understand how to engage us. But before that, let me answer these questions. How can we make sure we invest in, how does apartment buildings comes into play? So apartment buildings, and if let's say you buy multifamily apartment buildings, you invest in some of those people's fund, they all are long-term rentals. They do not follow short-term rentals. They're all long-term rentals. If you have a rep status, you can save taxes through all of those. If you just go invest in some other funds, even though you have a rep status, the rules are a little more complicated, which I'm not even going over this call. Even CPAs do not understand those rules. It's very complicated. Just to very recap, the answer is this. If you invest in syndications and other funds, basically people say, and get a K1, have a loss, to use that loss? Yes, you can use that loss if you have rep status and if you have your own rental properties and if you have spent 500 hours managing those properties. That's all. That's a rule. But I know it's complicated and it needs to be tied down. But and bottom line is yes, that's how the multifamily and everything works. So understand that before investing. The next question I get here is, do I need LLC to save taxes and everything? No, everything I discuss has nothing to do with an LLCs. LLCs and stuff never saves you taxes. LLC can save you only time the LLCs, the entity will save you taxes under one circumstance, and that is when you have a S corporation. If you're doing tax planning with your CPA, they will walk you through this. Probably they will do something like this. Okay, if they're not doing this, then again change your CPA. They will walk you through this entity structuring. We do go through the outline and tell you this is your current structure. How does everything work? What are the rules? And then how you should be planning your investment, your buckets, rental, your S corporations. How should you be managing your funds? How should you be managing your rental property? We give you this. How do you set up your holding companies, your trust? We walk you through that. But I do want you to understand is everything on my screen doesn't not save taxes, but unless you do this, S corp. That's all. And when you need this, depends. We do a detailed S corp analysis. When I say detail, it's a complicated S corp analysis here. It goes through how much tax can you save with S corp analysis without S corp. Ken's is going to put in that together for I think next 2 months. But you need an S corp. Technical analysis, we're going to actually show you that in numbers because a lot of people give you random and wrong answers. But here, I want to show you something about the real estate. Just to recap, to answer this question you had, do I need LLC to save taxes? No, you do not. And only way you would save taxes when you start your business, it's going to be through S corporation, and it does not apply for rental real estate. What do I mean by that? Rental real estate only saves taxes without LLC. So S corp saves taxes, but you don't want rental real estate in an S corporation. When do you need S corp in a real estate or other business? Whole flipping, fund managers, property managers. That's where you need S corp to save taxes. As soon as you go into rental, short-term rental, long-term rental, you don't need corp and do not save taxes. You same amount of taxes with or without real estate. What else? I'm going to answer a few more questions here, okay? And then we're going to end this after I know these questions are done. Single member LLC, all the LLCs do not save taxes. But the one reason you would need a single member LLC beside tax is this. Not going to legal thing. You always need LLC for legal protection. Talk to your attorney about that, right? If you need one or not. From tax standpoint and from IRS standpoint, where I see the benefit of single member LLC is here. Not tax savings. Like I said, it does not save you taxes, but you need that to consolidate your short-term rentals into one activity. Not even long-term rentals. You can ignore LLCs for long-term rental for taxes. Short-term rental, there's a video again. Follow us on YouTube, follow us on social media. There's a 5-minute video on this one. Please watch that. Okay, there's a lot of good content on our social media. If you digest this, you'll be a good taxpayer. But just to recap on the video, what I said was single member LLC can consolidate all your short-term rentals under one activity, and then you can count all the hours to meet the material participation to save taxes. That's the only reason. If you do not understand that, please look at the video. Just to recap, and it ties to what I was saying earlier, you need material participation hours to save taxes from rentals. Having LLCs and having all your rentals under one LLC helps you meet that material participation. That's the only reason, not because of direct tax savings, one of the tactics to get there. I see there are a lot of questions, but I answered most of them throughout the webinars anyway, so I don't think we need to go through them. Kensley, I know there was a lot of information. You can play this back. We'll send this through newsletters to everyone anyway, so they can watch this. If you guys have any questions, please email so we can address this. If you want to talk about any other topics on the webinars, if you can give a suggestion, we'll do that. We'll do that S-corp analysis webinar next, very detailed, and you guys can that for S-corp analysis. And also we'll do this LLC structure as well. So the next webinars based on how to manage your LLCs and for tax savings and all those things. And the second thing is, do you need a corporation to save taxes? Detailed analysis. Those are two good topics that people are requesting. Other than that, everyone, thank you for joining. We will talk to you guys again on the next webinar. Please feel free to reach out and have a great night there, and I'll have a good day here. Thank you.